Welcome to this explainer. If you've glanced at your feed lately, you know exactly what I'm talking about. Making sound financial decisions right now, it honestly feels like trying to drink from a fire hose of sheer chaos. You're getting hit with constant alerts, wildly confident hot takes, and just an endless stream of get-rich-quick promises. Well, today, we're going to cut right through all of that noise. We're filtering out the financial hype and zooming in squarely on reality. I want to give you a really clear, actionable playbook so you can protect and actually grow your wealth in a market that's, let's face it, getting more volatile and confusing by the minute. So let's dive right in.
Let's start with a surprisingly serious question. Who is really managing your money? Think about it, because right now there is a massive tug of war happening for your wallet. On one side, you have traditional human financial advisors, and on the other, this rapidly rising tsunami of AI tools and social media influencers who are basically promising overnight wealth. This is a very modern conflict, and as an investor, you absolutely need to understand it because whoever or whatever algorithm you end up listening to is going to directly impact your financial future.
Which brings us to part one, the age of financial hype, or as I like to call it, the age of noise. We're living in this era where pure digital noise is constantly masquerading as legitimate investment strategy, and it's exposing everyday retail investors to completely new types of micro-risks. Just look at this number, 1.1 million. That staggering figure? That is the wait list for Polymarket, a prediction market platform here in the US. Now, you'll see influencers pushing these platforms as a totally valid way to invest. They'll tell you that you've got an edge by predicting news events like elections or whatever the government is doing next. But let's be absolutely clear about what the data shows here. This is essentially just gambling. Prediction markets carry what we call asymmetric risk profiles. Sure, you might make a quick 10% on a highly probable event, but you are risking 100% of your capital to do it. You're literally just rolling the dice against the rest of the market. There's no real edge to be found here, just a whole lot of hype.
Moving on to Section 2, the AI Advisor Illusion, and this new $200 a month pilot. We've seen this recently, right? OpenAI announced a brand new finance feature built into ChatGPT, specifically designed to offer tailored financial advice for a monthly subscription fee. You can even hook up your bank and investment accounts directly to the platform.
Honestly, it sounds incredibly convenient, doesn't it? But there is a massive, critical gap here that we have to talk about. AI platforms and those TikTok gurus, they have absolutely zero fiduciary duty. None. They carry zero legal liability if their advice completely tanks your portfolio. Their primary focus at the end of the day is just engagement and entertainment. On the flip side, a registered fiduciary is legally bound by a duty of care. They are heavily regulated and they have a strict mandate to put your personal financial interest first. Listen, an AI slapping a not financial advice hashtag on a prompt is not going to magically protect your life savings.
And just to give you a lighter but honestly vital reminder of why that distinction matters, large language models hallucinate. A lot. When someone asked one of these models how many E's are in the word 17, it famously responded that there are no E's in SEVENTEEN. It's a funny little quirk, sure, but it hits the nail on the head regarding a very serious flaw. You really need to think of AI in finance sort of like WebMD for your health. It is a fantastic starting point if you're doing general research, but given its tendency to just confidently invent facts or completely stumble on basic logic, you would never trust it with a final, life-altering medical diagnosis. So why on earth would you hand over the keys to your financial independence?
That perfectly tees up Section 3, debunking TikTok wealth hacks. Because that total lack of accountability we were just talking about, it is running rampant over here. If your feed looks anything like the average investors these days, you are just flooded with these viral trends setting wildly unrealistic expectations.
You've got to beware the myth of the massive, consistent monthly return. You see influencers claiming all the time that you can easily pull in a 2% return every single month through prop trading or just by blindly buying up whatever tech stock is hyped that day. Let's ground this in reality for a second. If you actually consistently pulled 2% a month, you would be one of the most famous, world-renowned investors on the planet. You certainly wouldn't be selling internet courses. The business model for a lot of these prop trading firms isn't actually to share massive profits with you, it's to collect upfront fees from retail investors who are inevitably going to fail their incredibly strict trading challenges. They're just selling an impossible dream.
Okay, so let's pivot away from the digital noise and look at the real world. Section 4, the real macro market risks and systemic threats. These are the actual, heavy global forces that are currently moving the markets. This is the stuff that should truly be on your radar right now.
I absolutely love this quote from JP Morgan Chase CEO Jamie Dimon. He was talking about the current panic happening in the private credit market, and he said, when you see one cockroach, there's probably more.
Now, if you aren't familiar, private credit is this massive $2 trillion shadow banking industry where non-bank institutions lend directly to private businesses. And for years, it offered really great returns. But recently, we've started seeing major defaults from companies like First Brands and Tricolor. And the scary part is, these were businesses that were given completely clean bills of health just months before their debt was written off to pennies on the dollar.
Which brings us to what I call the Roach Motel analogy of investing. As those defaults have ticked up, retail investors naturally got spooked and tried to pull their money out of these private credit funds. But here is the problem. These funds hold illiquid assets. We're talking about private loans that take years to mature. Because of that, major funds run by absolute titans like Blackstone and Blue Owl have started gating their funds. Basically, they are legally restricting your ability to make withdrawals. It was super easy to slide your money in when the hype was high, but suddenly, everyday investors are finding it incredibly hard to get their cash out when they actually need it.
Another massive risk out there is trade policy volatility. Just look at the recent chaos surrounding U.S. tariffs. So you had a 1977 law that was used to impose these sweeping tariffs globally in April 2024. But then fast forward to February 2026, and the Supreme Court ruled it unconstitutional. That single decision threw $175 billion straight into legal limbo. And almost immediately after that, temporary 10% replacement tariffs were issued under a completely different law. Now, regardless of where you stand on this politically, strictly from an investment standpoint, this kind of rapid, unpredictable policy shifting creates massive friction for global supply chains. It introduces very real, very sticky inflation risks that hit corporate earnings directly.
And hey, speaking of inflation risks, we cannot ignore geopolitics. Roughly 20% of the world's entire global oil supply passes through one single, extremely narrow waterway, the Strait of Hormuz. With the ongoing conflicts involving Iran, even a temporary disruption in that strait doesn't just bump up gas prices at your local station. It sends major shockwaves through the entire global economy. It drives up freight rates, it hikes manufacturing costs, and ultimately it pushes up broad inflation levels across the entire board.
So we've got digital hype screaming at us on one side and these heavy, real-world macro risks on the other. What do you actually do about it? Let's transition into our final section, Section 5, the Actionable Investor Survival Guide. I really want to leave you with a clear, straightforward playbook for navigating this exact environment.
First things first, let's fix that information feed of yours. The CFA Institute actually offers this brilliant, super simple 3-step framework to help you vet any financial advice you come across online. Step 1, assess the motivation. Are they getting paid some sort of referral fee to push you toward a specific prop trading firm? Step 2, check the consistency. Does their promise of a massive guaranteed return actually match up with the historical realities of the stock market? And Step 3, verify their qualifications. Are they a registered fiduciary or just some guy on a bathrobe who rented a private jet for a 10-second video? Apply this filter strictly to everything you see.
Next up, we really need to understand what financial planning actually is at its core. There was a recent Vanguard poll that found the #1 reason investors seek out human advisors isn't to beat the S&P 500, it's actually for peace of mind. See, wealth management isn't just some math problem that an AI can solve instantly in the background. It is fundamentally an emotion management problem. It is all about feeling secure when those volatile macro events hit and avoiding the kind of panic selling that historically just devastates retail portfolios.
So let's take everything we've talked about today and distill it down into 3 concrete steps you can take right now to insulate your portfolio. Step 1, diversify beyond your home bias. Don't just invest in your own country's infrastructure or tech sector. Geopolitical risks, like the tariff chaos we talked about, show exactly why you need global exposure. Step 2, verify asset liquidity. Learn the lesson from the private credit panic. You need to ensure you understand exactly how and, more importantly, when you can pull your money out of any investment. And Step 3, ignore the short-term news cycles. Please, do not trade off of daily headlines or geopolitical panics. True wealth is built over decades, not days.
Which leaves me with one final vital question to ask you. Is your portfolio built for internet hype or is it built for peace of mind? Take a hard, honest look at where your money is sitting, who is advising you, and what their true motivations really are. Look, the noise out there is only going to get louder, but if you stick to the right playbook, your financial foundation can remain completely unshaken. Thank you so much for joining me for this explainer, and remember, keep your focus on the long game.